It was the second largest company in their industry. But today, it might go bankrupt. What went wrong? Hi, I'm Frankie. Welcome back to my fuck show. Today, I want to talk about Sapura Energy, what caused them to lose steam in the business, and why it couldn't make a comeback despite oil prices strengthening. The oil and gas industry is well known as one of the most lucrative industries. In its heyday, especially around 2014, Sapura Energy's market cap stood at close to 30 billion ringgit, making it the second largest integrated oil and gas service provider in the world, after Italian giant Saipem. With that kind of outstanding performance, the top executive of Sapura Energy was given a salary of 84 million ringgit in 2017 and 72 million in 2018. Sounds unbelievable, right? But that was the market standard for oil and gas top executives in those days. Now, let me give you a background of the industry. Prior to 2014, natural gas prices were as low as $2 per MMBTU. Who would want to drill wells at that kind of dirt price? But as prices started to go up, the US started to unleash its shale gas potential. By mid-2010s, the US has become a net exporter of natural gas. This phenomenon has been no less astonishing in the oil market too. At the point in time, crude oil prices shot up as high as 110 per barrel. During this period, the US has increased its oil production from just over 5 million barrels per day in 2008 to more than 7.4 million barrels per day by the beginning of 2014, the largest 5-year increase in crude oil production in the US history. It is in this setting that Sapura took advantage of the high oil and gas prices. They started to conduct a series of fundraising activities to fuel business expansions. Long story short, by the end of 2018, the top shareholder of Sapura Energy, which is a GLC company known as Permodalan Nasional Berhad, or PNB, had forked out a total of 2.7 billion ringgit to fulfill Sapura's appetite in the business expansion strategies. Even though Malaysia is a net exporter of oil and gas products, in the global context, Malaysia is a small contributor to the world's total production. And Sapura Energy was already the largest service provider in Malaysia. So the only option was to expand its business operations overseas so that they could generate enough returns for their investors. It went to Mexico, Brazil, Venezuela, Angola, India, and many more exotic countries that are oil-rich in nature. But the thing is, Sapura Energy was not familiar with those territories. To make things more challenging, it was not like Sapura was dealing with multinational companies like Shell or Exxon of the world. Their clients were mostly local businesses. Dealing with different ways of doing business and cultures is entirely different from operating a drilling rig for oil and gas. The point I want to make is that Sapura was taking big risks doing that. But it was okay, right? I guess they thought it's part and parcel of learning. And what could go wrong since oil and gas prices were so high? The high prices could baffle any circumstances if anything goes wrong. Well, everything went well according to plan. Except one thing, oil prices crashed to below $40 by end 2015 and everything changed. With oil prices going down, oil and gas production slowed down their drilling activities as it was not profitable to continue operation. Sapura, as a service provider in the upstream, suffered a big impact. During this period, oil-producing countries changed their strategy to focus on downstream. That includes Malaysia. Petronas was quick to react with the market condition to initiate the RAPID project, short for Refinery and Petrochemical Integrated Development. What's RAPID? Inspired by Rotterdam, it is a mega project development in the oil and gas downstream space. Rotterdam is one of the most important ports of petrochemical products in the world, doing business between the European continent and other parts of the world. For Petronas, going downstream shields the group from the volatility of the oil and gas prices. But this did not help Sapura Energy, as their business focuses more on upstream businesses. This meant fewer jobs for the company within Malaysia, pushing it further to secure jobs overseas. But remember, it was a global oil price crash, so even overseas, there were very few jobs for them.
I will not give you a penny more. That is the best I can do.
And at this time, they were just at the beginning of their massive expansion. I guess It's just a bad stroke of luck for them. And very soon, Sapura Energy was struggling with cash flow issues. To overcome this struggle, Sapura has come to a point to start divesting their assets away to raise funds to stay afloat. In 2018, it sold off 50% of some of its Malaysian assets for $540 million. In April 2021, Sapura continued its selling spree to dispose of some upstream assets offshore Peninsular Malaysia to Jadestone Energy for merely $9 million. Although they managed to boost their cash flow by selling off these assets, it meant that they have less assets to operate in the future. In other words, they were cutting their own flesh to feed their hunger. As a long-term investor, this became a worry. Many started to speculate that perhaps Sapura's next move would be to sell its drilling rigs as well, since only half of the rigs are being utilized as we speak. Currently, it has a total of 14 rigs under the company, 3 fabrication yards, 15 pipe-laying vessels, and 15 other ships recorded in the balance sheet. All these assets are worth roughly 48 cents per share, which is almost 9 times of the share price today. On one hand, if they were able to sell off one of 2 of those assets, they could keep the company afloat while waiting for oil prices to go higher. On the other hand, when oil price goes up, they will have less assets to operate, which limits their profitability in the long run. As you can see, Sapura is dancing on the edge of a knife. So far, I've been painting a gloomy picture for Sapura, but just how bad the situation is for the group. As at July 2021, Sapura Energy holds about 700 million ringgit cash versus a short-term debt commitments, debts that the group has to pay within the next 12 months of a whopping 11 billion ringgit. Luckily, it managed to refinance a big chunk of those debts with a consortium of banks to slowly repay the money over the next 7 years, giving Sapura some breathing space while trying its very best to pull the business out of the bad situation it faces. Nonetheless, they still need to fork out 550 million ringgit a year to cover their interest expenses, and that's making investors scared over the future of the group. Recently, Sapura released a shocking set of financial results. On the back of rebounding oil prices, the group still made a loss of 1.5 billion ringgit. The number shocked the market. I wonder what went wrong. Anyways, this year itself, some of the founding members, which includes the CFO and the founder Tan Sri Sharil, have stepped down from their leadership positions. It seems like they are going through some serious leadership revamp. Based on the latest news, the new leadership team is made up from some high-profile, celebrity-like names in the oil and gas industry. But will this be enough to turn the ship around? To sum things up, Sapura Energy's main issue is its cash flow problem. And despite the strengthening of oil and gas prices, without cash, the operating conditions that are confronting the group will be challenging. I mean, oil and gas is an industry that requires big capital investment upfront and then slowly recouping back the money as projects are being executed. Not having enough cash in hand to deploy at the start of a project means there's no way for Sapura to go anywhere. And at this point, I believe most banks are very cautious about lending more money to them. It's a chicken and egg situation. And to make things worse, the impact of the COVID-19 pandemic had caused execution delays in some of Sapura's overseas operations. According to management, Sapura had to fork out 460 million ringgit to handle the direct impact from the COVID-19 pandemic. But let's not forget, the underlying losses could be even more, as some of it are in the form of opportunity costs and potential earnings. My point is, the real loss is certainly higher. That's all we have for today. #Pub.